This seems like a very asymmetric outcome that we are looking at here. Steady state, nothing changes. You see small gains in terms of the direction of travel for markets, i.e. S&P upwards, what's happened with the dollar, etc., etc. Is it really as asymmetric as it looks? And how quickly will the market narrative change from the kind of initial shock reaction of what the result is to kind of pricing it in? Because I've seen so many notes now telling me that the initial reaction is not the final reaction and that the market will move through that very quickly. So what is that gap between shock and rationalisation?
Well, I would suggest that it actually depends on how things actually pan out, because if like I said, if we do get a Clinton presidency, that's more or less what the market is currently priced for. So if we don't get that, there's a repricing coming. But as we've already discussed, that secondary effect of how Congress looks could actually have a bearing on Hillary Clinton's ability to get policy implemented if she does win. Having said that, and just focusing on a word you just picked up there, symmetry or asymmetry, I think back to foreign exchange, you could see actually different responses, and that is probably due to the current positioning in the market. If you look at where the market is long in the foreign exchange space, it's currently against yen and Australian dollar. So if the US dollar does rally here, you could see those currencies actually weaken off a little bit purely from a positioning perspective. If we go to the other extreme, where the market is very short, comes as no great surprise, is the pound. Now, we saw quite a significant week for the pound last week, quite positive. Our view here at BNP Paribas is that the pound is now very undervalued, and we look for a rebound to around 130 to 135. So if you put that in there, what that means is if the dollar does rebound, the pound is not the currency to sell against a resurgent dollar. My money would be much more on a currency like the yen or the Australian dollar to weaken off against a resurgent US dollar. And the key driver here is the positioning, the way the market is positioned going into this election.
So let's talk about positioning, and let's talk about some very intriguing price action in a currency we can typically call a haven, and that's the Swissy, Steve. The Swissy is behaving very unusually over the last couple of days. In fact, Euro Swiss yesterday down 1/3 of 1%. And that's the currency pair I want to talk about. If you want to play Euro Swiss right now, what is the advice you're giving to clients?
Well, I think it's a key one to focus on, so I would be with you in looking at it. We've been looking at the 108 level in Euro Swiss. It's a very significant level, one that's held for most of this year, but we've actually seen Euro Swiss fall below that over recent weeks. So that's a strengthening of the Swiss franc. I think this is a little bit of nervousness ahead of the election, some safe haven hunting, which the Swiss is often in. But if we do get a risk rally, we would suggest a weakening of the Swiss franc is likely to happen. And we wouldn't be surprised if the Swiss National Bank would actually be supporting that move as well. Because remember, if you look at the foreign exchange reserves over this year in Switzerland, you can see that they have been intervening, or you can assume they've been intervening in the markets to try and prevent an appreciation of Swiss franc. So what that means is, the bottom line is the downside is quite limited in Euro Swiss, because you've got, I think, the Swiss National Bank there as something to really be taken quite seriously as far as the foreign exchange market is concerned.